Let's have a word of prayer as we start. Lord God, I want to thank you for the opportunity we have to discuss these things. Help each one to be able to have a clear mind. Help us be able to gain something from this. We'd be better able to serve you because of it. In Jesus' name, amen. The idea for this came up with the fact that this past fall, I did one of these for the faculty. It was suggested maybe we could do the same kind of thing for SAPA. Since I was a SAPA member for 6 years, I said, that sounds like a great idea. So that's how I came here as a SAPA member for 6 years, and then I switched over and wear a different hat. But I am still part-time staff, so I'm part-time director of finance, so I guess I still stand on both sides of the fence, so to speak. What I'd like to do is go over this. One of my responsibilities, I'm a certified public accountant, but also a financial planner, and so I have to get a lot of education in these kind of things. I think they're fun, and I thought it'd be helpful because they're also kind of complicated if you're not familiar with it. Thought it'd be helpful if we could go through some of these things. What I put together first, the first two slides here, it's PowerPoint. I do PowerPoints, but I don't actually show them on the screen. I just simply hand them out so you can make notes. And by the way, as we go through, if you have any questions, raise your hand and stop. Be happy to go over, because questions are like saying sick 'em to a dog. I enjoy questions because that way I can see if we're really addressing the needs people have. Things we'll try to touch base on is TIAA CREF, that pretty much all of us are involved in. Also individual retirement accounts. We'll talk about Roth individual retirement accounts, annuities, Social Security, and tied in, of course, will be Medicare. And then we'll have savings and investments. That's basically the way people get their money to take care of retirement. We're also going to talk about insurance, the different kinds of insurance we'll talk about. We have a retirement health insurance here. Back in 2000, 2001, it was decided, prior to that, it had retirement health insurance for all employees. At that time, they realized, when I first came in 92, I said, do you realize what the cost is on that? And finally, in about 2000, they realized, let's see what the cost is on that, because they were committing to people, for 30 years down the road to take care of their health insurance after they retired, and they realized the cost was in the millions. And so at that time, they said everybody that had, between your age and years of experience here at Spring Arbor had totaled 62, would be able to have retirement health insurance. I think it's coverage is probably not the greatest coverage, but they had that. And at that time, there was 126 people that were still working. They had that available. I believe now we're down to probably 50-some. The rest have either, retired or gone work somewhere else or whatever the case might be. So a few people will have that, probably not too many unless you're older and you've been here for a long time. It's interesting, we made a proposal and they actually adjusted our proposal. They put fewer people under it. And I was one of the kind of interesting situations. I made it within a month to spare. So we actually recommended a bigger group of people and they didn't accept that. But anyways, so there are still some people that have that available to them. Health savings accounts. Health savings accounts, what we have here at Spring Arbor. If you actually can accumulate money that you could take into retirement, that can be used after you retire. So we'll be talking about that a little bit as well. Flexible spending accounts, what we have here. If you don't have an HSA, you may have a flexible spending account. The difference between an HSA and flexible spending account, an HSA, you put it in, it stays in. Flexible spending, if you don't use it by the end of the year, it goes away. So that's one difference we have there. Medical insurance, of course, another piece of that, and long-term care insurance. So that's what we're going to try to cover in the next period of time. First thing we'll start with is the TIAA CREF. TIAA CREF, obviously we've got a lot of different options. I'm on little box 3 if you want to follow where I'm going from. Box 3. Anyways, we talked about the fact that TIAA CREF, basically what we have here is a lot of different options for people. The TIAA is your fixed, where you get a certain return, it never goes down. And if people are conservative, they say, I want to go TIAA. Be aware that over time with TIAA, you're probably going to end up with a whole lot less money in retirement than you will with CREF. If you go with stocks, the problem with stocks is they go up and down. And we enjoy that excitement at Cedar Point. We don't enjoy that excitement with our investments, but that's one thing to be aware of. But if you have a long number of years before you retire, it makes sense to have a certain portion of your money in some stocks because they have a lot more growth possibility. Over the last 70 years, they've probably grown about 8 or 9%. Your fixed, like your TIAA, has probably grown maybe 4 or 5%. And that makes a significant difference over a long period of time as far as how much you'll have. If you're very conservative and go with TIAA, you're going to either have to put in a lot more money or you're going to have a lot less in retirement. So you can put in any mix, and the mix you have you can always change. And the money you have already put in will stay where it is. So there's a lot of different options you have as what you put that in. As it talks about, Spring Arbor currently puts in 7% for all full-time pay, and we don't have to contribute anything, but we can. We can put money in. As it talks about here, how much you can contribute if you've not reached the ripe old age of 50, you can put in 17.5. Doesn't mean you have 17.5, but if you had 17.5, you could. Someone say, well, how would I have that? Possibly someone maybe receives money from an estate or something. You say, I've got some money over here that's taxable. How about if I just have some money taken out of my pay for the next year and just kind of slide that money into my living expenses and move the 17.5 over out of Uncle Sam's hands? Best illustration that you can see with these kind of investments, it's like an umbrella. The umbrella keeps you from being taxed. If you can keep it from being taxed, it's going to do much better. And so what we have here with TIAA CREF, it's tax-free. Not tax-free, it's tax-deductible when you put it in. It's not being taxed during its life, but when you pull it back out, it's going to be taxed. Bear in mind, if something is deducted initially, you're going to have to pay tax on it later. One of the options we'll look at does not get deducted initially, but nor is it taxable later. So that's kind of the philosophy the government has with that. As I said, if you're over 50, you can put $23,000. Again, most of us probably couldn't put that, but that gives you an option if you wanted to put more aside. One of the things with this, when you hit 70.5, you have to start pulling out something unless you're still working. And that's where you turn to the second sheet I gave you. Some people were already asking questions about that. What this is an annuity table. Basically, it's a life expectancy table, rather. You say, how do you use this? At 70.5, look at 70, it says 17. Divide 17 into 100, and that tells you what portion you need to take out each year. And this basically you use to figure out how much of your amount you're required to take out each year. You have a minimum withdrawal, and that's what we see here. Notice each year it's a shorter period of time because you're getting farther along in age. Next year you divide by 16.3, then 15.5, then 14.8. So each year you have to take a little larger amount. And that's assuming you're retired. Now if you haven't retired, you can continue putting in. But at 70.5, if you don't pull out what you're supposed to out of your IRA or out of TIAA CREF, the tax penalty is 50%. So if you were required to pay out take out $10,000, you took out nothing, they would charge you a $5,000 penalty. You don't want to miss that. So at 70.5, you need to start pulling out the minimum. You can pull out more, but you have to pull out at least the minimum. And the penalty is 50%. So it's a pretty harsh penalty. Because these are retirement accounts. And the intention with it for retirement accounts that you use them for retirement. And that's why they have a high penalty if you do not pull them out at that time. Now you can pull out more than that, but this is the minimum you have to pull out at that point in time. And with that, also, we can take out more than that if you choose to. So if you have money in TIAA CREF and you're retired, instead of pulling out the, say, 4 or 5% you're supposed to that year, if you want to pull out an extra $5,000 or $10,000, it's your money, it's no problem. But when you pull it out, it becomes taxable. Remember, it was deductible. It was deducted from your income when you put it in. Now when you pull it out, Uncle Sam's, remember me? I want to get a piece of that. So the government's going to either get you one way or the other. It's deductible initially, but you pay tax on when you get it out. Now, if you're in a lower tax bracket, maybe that won't be an issue. But at least that's something to be aware of. It is taxable, but it's something that gets taxed when you start pulling it out. And that's why they want you to pull out a certain amount to make sure that they get their hands on your money. And so that's what's happening with TIAA CREF. The next page, we see individual retirement accounts. You can have an individual retirement account in addition to the TIAA CREF. An individual retirement account, you can put the money in and it's deductible just the same. The limitations on that is $5,500 this year. And if you reach the age of 50, it's $6,500 you could put in if you wanted to put in more. That's out of earned income. So if you've made income of a certain level, you can put that much into it. This again is deductible when you put it in, but when you pull out, it's taxable. And these are another one of the ones that fall into the same set of rules as far as how much you have to take out each year, and the fact there's a 50% penalty if you don't pull it out later on. So individual retirement account is another option. Now with this, you can't pull it out till you're 59.5. I believe TIAA CREF is probably the same. Until you're 59.5, unless you're disabled, you can't pull it out because it was designed for retirement. And so if you take it out before you're 59.5, they hit you with a 10% penalty plus it becomes taxable. So be aware with TIAA CREF and with your IRAs, before 59.5, there's a 10% penalty plus it's taxable. So obviously, you want to try to avoid pulling it out early because if you do, you're obviously going to have a pretty significant amount of taxes on that. Any questions so far? I know I've gone over this fairly quickly. As I said, there's an exception for disabilities. If someone's disabled and you're not 59.5, there's exceptions where you can start taking it out without a penalty. The next one we have, which is probably a better option if you're going to go with an IRA, is a Roth IRA. Roth IRA, senator from, I believe, the state of Delaware came up with this idea. With an IRA, you're deducting the money before you put it in, but it's becoming taxable when you pull it out. So say, for instance, you've put in $40,000 over a period of time, and now it's worth $150,000. So they let you deduct 40, and they're going to tax you on 150. Pretty neat deal for the government, isn't it? Well, another option you have is put it in initially. Under a Roth IRA, it's not deductible. But you don't have to pay taxes on it when you pull it out either. So a Roth IRA in almost every case is much better than a regular IRA. And there's another reason why a Roth IRA is better, is there's no time when you have to pull it out. You could choose to leave it in there. When you pass away, it goes to your beneficiaries. Now the IRA will as well, but with the IRA, the illustration I can think of is when my dad passed away, rather my mom passed away, I wanted to get her IRA to dad. Well, getting it to dad was pretty easy, but I was trying to figure there's got to be some way to beat this tax thing. Guess what? There's not. Because it was at her IRA, he was the beneficiary, it rolled over to him, but then as he pulls it out, the government still gets involved. The government still taxes. If that had been a Roth IRA, no one would have paid taxes when they pulled it out. So a Roth IRA is not taxable when you pull it out, and assuming your money's grown at any kind of level, you're putting a much smaller amount in than you're taking out, and there's no 70.5 requirements to pull it out. So a Roth IRA is much more flexible. You can pull that out later or never pull it out. It becomes part of your estate, goes to your beneficiaries. So a Roth IRA will be a better option given in almost every situation than a regular IRA will be because they're tax-free. As I mentioned, if you pull this out before 59.5, there's also a penalty for that one as well. Annuities. Annuities is another thing, especially with TIAA CREF. One of your options when you get ready to retire is you can say, what would it be if I take this amount of money I have in TIAA CREF and I give it for my life? And they will give you a figure. You say, well, in case something happens to me in maybe in a year or two or three, I'd like to make sure at least goes on for 10 years. They'll give you another figure, which would be less than the first figure. Because first time they're just covering one life. Now they're covering one life with a guarantee of 10 years. So they'll give you a little bit less each month. Another option you may want to consider, especially if they're married, what happens if something happens to me, I'd like to have anything left go to my beneficiary. Not a problem, but guess what? The monthly amount goes down. Because now they're covering two lives and not one life. And yet it still makes sense. I would say in virtually every case, you would want to make sure that whatever you have, if something were to happen to you, would go to your spouse. I give the illustration of, unfortunately, it's an illustration of what happens if you don't do it right. My grandfather retired at age 60. He was very healthy, playing tennis and everything. At that time, my grandmother was 55 and she had cancer. Didn't think she was going to last that long. So Grandpa retired for 44 years at GM and said, we don't need anything for you because I'm going to outlive you anyways. You can see where this is going. He lived another 21 years. He died. She lived, I think, 25 years after he died. And even though he'd been at GM for almost 44 years, other than his health insurance, she had no retirement from him. Because he made a choice of one life only, because he was going to outlive her. Well, we never know how long we're going to get to live. So if you're married, it would certainly make sense to have a portion. Either the same amount go to your spouse, or half as much, or whatever, because we don't know for certain what's going to happen. And that's an illustration, unfortunately it's a true illustration of what happened, because both of them agreed together. It makes sense. He's going to outlive me. I'll go ahead and get that. And then, of course, he passed away at 81 and she dies at 97. And she was already 5 years younger. So you can see it was a lot of years she was trying to live on very little because they had assumed that he would outlive her. And so bear in mind when you do that, you do set it up, you certainly wouldn't want to factor in a spouse. Now there's another option to look at with this, many people don't think about, is once you annuitize it, it will take care of you for life and for a set amount of time or a spouse, but when you're gone, it's gone. Another option you would have is, what if you say, especially in the early years, just send me so much, at least enough to cover the minimum, send me so much a year. Now, if something happens, the principal that's still there goes to your beneficiaries. And you could annuitize at a later time. So by doing that, you're not committing, because once you've made that commitment, it's irrevocable. You set up, okay, this is going to go for my life as long as I live, maybe for my spouse or for 10 years, but when those things transpire, it stops. Where you can say, I really don't want to annuitize it quite yet. Why don't you send me about the same amount of money, and we'll still leave it there. And then you wait another year or 2 or 5, you could annuitize it later. In other words, you can make that commitment later. Because once you make the commitment, you can't unmake the commitment. Because you're making a commitment, you'll give them all that money, and they will pay you so much as long as whatever the arrangement is, your life, or maybe your life and your spouse, or for a 10-year guarantee or whatever. But once they've made that commitment, you can't go back and undo it. Now, if you live a shorter period of time, they win. You live a longer period of time, you win, so to speak, because they're making a guarantee to you. And once you make that, it's irrevocable. You cannot undo it. So you do not have to annuitize exactly when you retire. You could, but you could also choose to delay it, maybe never annuitize it. Because if you don't annuitize it, then when you pass away, it goes to your beneficiaries. Just something to be aware of. Many people assume that they have to go ahead and lock in. You may want to, but you may not want to. And also, maybe you could lock in part of it. Depending what you have in TIAA CREF, I'll lock in part of it and part of it I won't. Just try to think of all the options you have and try to figure out which one's best for you. And of course, health situations, you could decide not to lock in now and maybe a few years later you have some health issues, it makes a difference. Or if you find out you had health issues, you say, I'm glad I didn't lock it in. Because you have health issues, you may not live as long, and if you had locked it in, you would have had it all gone in a much shorter period of time. Does that make sense to people? The key thing is, it's your decision. You need to try to figure out, with the insurance company, of course, or TIAA CREF, they would much prefer you have you lock it in. Because if things go well, they can come out ahead. Of course, if you're going to live longer than average, and all they've done, one thing that's happened is some of these companies have not changed their annuity tables. What's happened to the longevity of people in America? It's gone up. So if they don't change their annuity tables quite as quick, who gains? The insurance companies or us? Actually, we're actually being hurt by it because they're assuming we're going to live a shorter period of time. And so, they can have some benefit both ways on this. So just be aware of change of annuity tables. You need to make sure that the TIAA CREF is using an up-to-date annuity table. Otherwise, they could be factoring in them not giving you as much as they should. So just to be aware of some of those things as well. Let's turn to the next thing, Social Security. Social Security. Social Security is interesting. Probably most of us obviously be getting Social Security, but there's a lot of different ways of handling Social Security. Unless you're disabled or unless you're a widow or widower, you cannot get till 62. I believe you can get 60 if the other situations or disability comes in before that. Normally you have to be 62 before you can get any Social Security. Now, depending on when you were born, it's factored in on your full age. Now, I happen to be in a bracket that gets at age 66, I get full Social Security. So I could either get an amount at 62, or I can wait till 66, or I can wait till 70. Between 62 and 70, it keeps going up about 8% a year. So the amount you would get continues to grow. Now, once you've locked in, obviously, you start getting Social Security, they've committed, and that's how much it's going to be from then on. But one option you do have, normally speaking, if someone's married, their spouse, if they're, again, approximately the same age, when you retire, your spouse gets half as much. What if your spouse was working? What you can do is look at it both ways. Okay, should my spouse wait until I retire or they retire and get half, or do they do it on their income? And actually, you should work at both ways to see what's worthwhile. Maybe one says, I will get based on my spouse, and I'll let mine continue to grow till I'm 70. Then I'll get mine then, because it'll be a higher amount. Or you could go the other direction. So there's a lot of different ways to compute which is the best, especially when there's two lives involved. Which is the best? Do we both retire at 62, 65, 66, 70? And it makes sense to sit down and figure out which is better for you. One thing that's kind of unique about this, and it's probably not real public knowledge, is when you're at 66, our plan, my family is, I'm going to, quote, start Social Security. I'll sign up for it, and then my wife will get up to about half of what I was making, what I would have gotten on Social Security. But before I actually get it, I'm going to suspend it. And I'll continue letting it grow till I'm 70. But at that point, she can go ahead and bump up to half of my Social Security, because after I hit age 66, the half will not go up anymore, it stops. So it makes sense for us, as soon as I hit 66, to sign up for Social Security. Her income gets bumped up to half of that, and then I go ahead and suspend it so I never actually get it, and mine continues to grow till I'm 70. Yes?
I'm not sure she gets half of hers.
Well,
because if she's 64,
but
she would only get...
She would get a little less.
She would get a percentage
Yes,
of hers
correct.
up to...
Yes. In our case, she's actually a little older than I am. And actually, another thing, she's actually started a year early. Because she's starting a year early, she'll get bumped up, but not quite. If she weren't getting anything, it'd be half, if she was 66 as well. But again, each person, good point, each person's situation is different. Is the spouse older or younger? Because they're a little bit younger, they're not going to get quite as much. If they're older, they would still get that.
They get whatever their percentage is if they were to take theirs.
Correct. No, actually, they have a choice on hers, or she has a choice on half of mine, whichever is the higher of the two.
Right.
So in our case, because she's not worked as much, She's just starting on her retirement this month, and then when I hit 66, she'll get an extra $200 or $300 a month based on, being not quite half of mine, but being bumped up based on, my income. So again, every situation is different. And in our office, we have some where the spouses are, 5 years difference in age or 7. That throws a real monkey wrench in things because the other person may not even be old enough to retire. So each family needs to look at their own situation, but just be aware Social Security it's not quite as easy as I originally thought, that you just wait to a certain age. Also, if you work and make money up until your full retirement age, for most of us, looks like here we're 66, some of you maybe 67. I wrote down here, I think I wrote down when you have to be 67. I think if a person's born after, was it 1960? 1959. Anyways, at that point you have to be 67 to get full retirement. But up until that full age, if you work, if you make over $17,400 a year, $17,400 a year, you have to give back half of what you got in Social Security. Once you hit your full retirement age, it doesn't get penalized. So if someone's working and getting Social Security at the same time and making over that, which would be probably most people full time, you would actually be losing some of your Social Security. So if you hit your full age, then you don't lose Social Security. Prior to that, you do. But you also have a taxable situation that mentions here is if your family income is, for two people, is over $44,000, your Social Security will be 85% of your Social Security will be taxed. If you're below $44,000 for a joint adjusted gross income, it will not be taxed. If you're single, it's $34,000 adjusted gross income. So in other words, if you make very much, some of it won't be taxed. It'll be taxed. 85% of it will be taxed. So your Social Security will not be taxed unless you're above $34,000 as a single or $44,000 as a family income. So you can get it at age 66 or whatever and continue working, but bear in mind a lot of it's going to become taxable. If you stay below that, it's not taxable. Okay? And another interesting thing is if someone's been married before and they were married over 10 years, not 9 years, 11 months, but 10 years, they can base their Social Security also on what their former spouse was. So that's another option if someone has that in your history and you were married over 10 years, you can get based on your former spouse. So it's just another piece into the equation that might be an impact to some of you. It's just one of those things they set up. If you've been married 10 years, they felt that you should get your Social Security from your former spouse. Now, whether that's going to be worthwhile for you or not, but that's another option to be aware of. Savings and investments. I want to mention the next thing. With savings and investments, most people say you should have 3 to 6 months living expenses set aside in cash. 3 to 6 months set aside in cash. That's obviously a challenge. But actually it makes sense. Not that you get it immediately, but over time to build up that kind of reserve. Think of the things that would take care of a lot of stress. If you're able to have that kind of money, probably your best if you have that kind of money is maybe put it in a money market, maybe earning about 0.5% to 1%. Money markets, I have one that pays a little over 1%. A money market, I probably should talk about that. A money market's like a glorified checking account, only you have to write checks for at least $250 or more. And also, you're usually allowed like 3 checks a month. So it's designed as a holding tank for your money, if you will. But it'd be a good place to put this kind of money because it's immediately liquid. I could write a check anytime I want to and pull the money out. And you may have, maybe there's a death in the family, you've got to fly somewhere. There could be a major health issue that comes up. Someone has some job changes, anything else happens. If you've got 3 to 6 months living expenses, you're going to be in much better stead than if you don't. And obviously, that's a challenge. In this economy, it probably wouldn't even hurt to have a little more than that. And obviously, if people say, how do I have that? My challenge for people is, first of all, try to get $1,000 set aside. That would be a starting point. And as you get more set aside, I know we've had some investments recently in rental property, and that's been a challenge. And so we've not been able to have quite as much as I like. You get much better sleep at night if you know you've got enough money that if you need to, you could draw on it. Now, you may never draw on it, but having it available really makes things go much easier. That way, if something comes up, there's a health issue or major car repair or something like that, you've got something to draw on. And that's really what it is. It's really a reserve to help you take care of those kind of things. Then as far as investments, once you get past that, it really kind of depends on people's risk tolerance. By risk tolerance, if you feel comfortable with more risk, then you can take more risk into some stocks and things like that. If you feel less comfortable, you don't invest as much in those kind of things. Generally speaking, the two genders tend to have a different perspective on risk. It's not bad or good, it's just the way God made us. Generally speaking, men are much more geared to risk, women are much less geared to risk. So somewhere in between is probably a good balance. God kind of knows what he's doing. He put those things together. Somewhere in between is probably a better balance. And as far as risk goes, probably as we get older, we need to probably have less risk in our investments. And the reason for less risk, if I take a chance when I'm young like Herbert and things don't go well, I got years to make it up. Say, what happens if you're my age and I take a chance and lose a lot of money? I don't have as many years to make it up. So probably as I get older, I probably need to take less risk. Doesn't mean no risk, because even at retirement, many people will live another, I think I just read recently that people that retire at 65, I think they live like another 19 years on average. So if you live in 19 years and you just have it in passbooks, you're in trouble. So you still need some in stocks and those kind of things, but probably not as much as you would have had when you're younger. I don't have all those years to go back and work and make it up. So you probably become a little more risk adverse as we get older, because seeing our investments drop is not quite as, it's more challenging, but it's more challenging as we get older than it would have been 20 years ago. And some of the things we can invest in, fixed income. Fixed income would be your CDs, but CDs right now, you're probably doing well to get 1%, maybe 1.5%, not a very high rate of interest, or treasuries, treasury securities, those kind of things. They're pretty low returns, and unfortunately, with those low returns, it's going to be kind of hard to live on that money. So you may want to do some of those. Another thing is you can buy annuities, regular annuities. You can buy an annuity, and when you buy an annuity, they're simply guarantee you get so much a year for 5 years or 10 years or whatever the annuity is. So you can do those kind of things, but again, when you do that, you've locked up the money. So I'm just saying that's an option you would have, but whether it's the best one. And if you want to get involved in stocks, one thing, unless you want to be involved in picking stocks yourself, is often index funds. I don't know whether you're familiar with index funds. Index funds have a much lower load. If you have a managed mutual fund with stocks, it's probably going to be 1.5% to 2% per year management fees. An index fund simply says S&P 500, the 500 biggest companies in the United States. Once they get it set up, the computer can automatically do the buys and sells. It doesn't involve any people, so the management load, their cost is usually 1/10 of 1%. So because it's 1/10 of 1% and the other one is about 1.5% higher, they would have to make 1.5% more to justify against an index fund. 80% of the time, index funds have outperformed the professionally managed funds. So that's another way to do it. You just get a cross-section of a lot of stocks. That way you're in a lot, it's kind of like spreading your risk, so to speak, not getting all your eggs in one basket. By doing that, you go up or down with the market. But otherwise, you have someone trying to pick the winners and losers. And there are some that have done it, but historically, to do it year after year, there aren't too many people that have done it consistently. Warren Buffett's probably the exception, but there aren't too many Warren Buffetts left. And by the way, he's 85, so he's probably not going to be around much longer. I don't know if you're familiar with Warren Buffett. He's the second most wealthy person in the United States. Berkshire Hathaway. When he started in 56 or 7, if you'd invested $10,000 right now, it'd be worth like $100 million. And he's done very well for himself. Still lives in the same house he bought in 1958, and drives older cars and stuff. Kind of a unique person, but obviously, when and his assistant's 91, so they're probably going to have some younger people involved. It's still, they've done very well for themselves, but most people are not Warren Buffetts to be able to do that well. So it's usually better off with an index fund, a much lower load. Then you can have your money working for you instead of paying someone a salary to pick the stocks, if you will. One of the things we have to be careful of is, as a retiree, you don't want to outlive your income. So if you start pulling money out of your investments, are you going to pull out 3%, 4%, or 5% each year? Now you can pull out a higher percentage, but what happens if you pull out a higher percentage when you retire? You could outlive your income. So generally speaking, you want to try to get on the lower end of that if you can, closer to 3% a year, and then maybe increase it with inflation every year would be much better chance of having that go 25 or 30 years than the other. If you go 5% a year, you could end up running out of money after 15 or 20 years. So again, it depends how your investments have done, but just be aware that there is a difference there. One thing I did mention with TIAA CREF, if you decide you want to take the money at a more rapid rate with TIAA, there is an exception to that. You cannot pull it out quicker than 10 years. I don't know whether you're aware of that. Even if you wanted to roll it over, in fact, when I first came here, I decided what I had in TIAA would be better off in CREF. I said, I want to roll it over, and they said, okay, we'll do it over the next 10 years. So if you're going to get money out of TIAA, you can get it out, but the earliest you can get out is 10 years. So even if you want to move what you have in TIAA into CREF, or you want to pull it out of retirement, you can get it out, but it'll be 10 years. And they've chosen investments that are very long-term, and that's why you can't get it out quicker than that. I'm not saying it's good or bad, that's just the way it is. CREF you could pull out immediately if you chose to, but TIAA you could not. So I just wanted to mention that. Our insurance, we've already mentioned the fact that some people still would have access to the health insurance. If you have any question whether you would be one of the ones qualified, get a hold of Donna Zimmerman, she would tell, yes.
So I am one of those persons that qualifies.
Okay.
Is that always going to be my better option for insurance?
No, but that would be one to look at. Because, good question, because at retirement, you say, what other options do I have? And by the way, when you hit 65, if you get Social Security, you will be on Plan A. You will be in Plan A of Medicare. You cannot opt out. We just went through that the last 2 months because my wife gets this thing saying, you turn 65 and you're going to be on that. And I said, what if we don't want to be on it? And they said, well, that's not an option. And so I went down to the Social Security office, went to Medicare, and basically came down with, you will be under Plan A. So you have at least Plan A. Plan A is free. Well, we've paid for it over the years. But then you have the other plans. So the school one may be better, but I would certainly do some checking because there may be other plans that are better as well, because then you probably have your Plan B and D. Some of the other plans that go with that. Are they better? I would certainly check around. Check with several places and find out which one's better. Because the school puts in, I think they put in around $4,000 a year, $4,200. So they put in some, so it should be at least competitive, but I'm really not certain. Has anyone got any more experience on that than I do? Yes. I would start looking earlier to make sure you got some time, but it's an excellent counsel because I've not gotten that point yet, but I know we did it at time.
Get into all these issues of your donut hole, and with or without, you get into the issues of co-pays with medications, and do you or can you have generic brand versus name brand? There are all kinds of...
And each family is different on that. The donut hole means there's coverage to a certain level, then they stop for several $1,000s, and it starts again. So some of our insurance is set up that way. So insurance is complicated, and unfortunately, it's probably getting more complicated as time goes on. Yes.
Who's a good person or agency to go to figure out which insurance plan you should go with? There's so many options.
If you have car insurance with somebody that covers that kind of thing, that might be a place to start. I would look in the phone book and look at some of the bigger insurance companies in town. There's a lot of insurance agencies.
Well, I'm going to sell their own insurance.
Each one will sell their own, but what I'm saying is you check with several of them. But the key thing with checking, as he mentioned, make sure you list what coverage you have with the first one you're using for a marker. Now let's see what the next one costs. Now what are the differences? Maybe it's more, but they're giving me more services. Or maybe it's less for the same price. You know, I would certainly do comparison because if you aren't, it's the same thing you do if you're going to compare your car insurance. Always list what's my current coverage. I want exact coverage if possible for comparison. Because it could be more, but maybe they give me a lot more coverage. So be careful that you get the same coverage with whatever you go to. And if there's a certain coverage you need, if there's some medications you're on, can I stay on those medications? Or I have a particular doctor, can I stay with that doctor? Those are very key things because all doctors are qualified, but let's face it, we all have certain ones we want to stay with. And if they're not going to stay with us, maybe we want to go a different direction. That's a really good question. Okay? Yeah.
Whereas if you go through a brokerage, they're going to represent a lot of companies, and hopefully it's going to be a great brokerage
Yeah.
that's going to recommend what's best for you and not what's just best for the bottom line.
Right.
And also with the law carriers.
That's a whole different thing. Some of the bigger ones in town, we've got Richmond, we've got Walton, some of the others. There's a number of other insurance. I think they're probably all reputable. Are they the best? But you could check online too. But probably wouldn't be a bad thing to also try to have them tell you what kind of rating they get with Best. Best goes through and rates insurance companies because you want to make sure, insurance is something you want to make sure it's there when you need it. And so most of these companies are very good. I'm not saying it's a problem, but make sure that they have a good rating because that's their financial strength to make sure that they can come up with the money you need when you need it. So Best comes through and does a rating of those insurance companies. And most of them are good, but it would be worthwhile to check ahead of time. That's good, yes.
For what it's worth, if any of you have spouses that do public have MESA insurance, you can't keep the MESA insurance in retirement, but they can shift you over to a plan that's called Blue Care.
But if you have that available, you probably don't need to do much checking, because I'm taking care of my mother-in-law's, and she's under that, and yeah. In fact, I think sometimes the providers see that and go, we can get extra, we'll do all these extra tests that we wouldn't have done otherwise because she has very good insurance. So if you've got contact with something that you get your MESA, that certainly would be a good thing, or comparable to MESA, whatever it is. Yeah, because the public schools have some of the best insurance there is, but most of us may not have that option for us. Next questions, next thing I want to go over. Health savings accounts. Now this is one of the unique things that I just learned some more the last couple of months. If you are going under Medicare A, in other words, you're signed up for, and if you're signed up for Social Security, when you hit 65, you will be on Medicare A. You cannot have an HSA at the same time. Now my understanding is your spouse can have an HSA. Now you can have one you put in the past, but you cannot put any new money in. If you do, they will come back and have you give back all the Social Security money that you've received during that time. And that's something we just came up recently, which was very frustrating. My understanding is, as long as it's my HSA, my wife can get her Medicare A. It's not a problem. But I have to make sure I stop mine in plenty of time so I don't get my Social Security and mess up the Medicare. Because when you are 65, if you're on Social Security, you will be on Medicare A. Doesn't matter whether you need it or not, you will be on that. People have gone through lawsuits on that, and they still will be under Medicare A. So if you get Social Security at 65, you will be on Medicare. Now, yes, go ahead.
Can you explain that, what happens? Because if you're still working, you still have your HSA or your prime, your point of choice or whatever. But how does
your HS
Plan A affect you after you turn 65 and you're still working? You still have your company's insurance?
If you have HSA, you cannot put money into HSA after you've got their Medicare A.
Right.
And so I could be drawing out of what I put in previously, and I could stay with the HSA Spring Arbor has, but it means Spring Arbor would not put the $1,800 a year, nor would I be able to put any new money in.
But what is the effect of when you turn 65, you're now under Plan A? You mentioned that a couple
Okay.
times. What's the benefit?
What I wrote down, I want to make sure I get it right. A covers, I believe, hospitalization. Yeah, A is hospital, B is doctors, and D is pharmacy. So Part A is hospital, B is doctors, various physicians, and D is medicine. So pharmacy. That's when you hear these different letters with Medicare. A is the hospital, and that's the one you have to go under. The others you do not have to, but once you're under Medicare and that's your primary care, you're probably going to need a B and D as well. And there's a lot of different options with B and D. But at 65, if you get Social Security yourself, you have to be under Medicare A.
Well, I guess my question is, I continue to work, I'm not taking Social Security, but I'm automatically under A. Now, there's, a surgery or something that has to happen. How does A cover? In other words, do I have to be worried any longer about my HSA deductibles? Because I'm still under HSA, I can't contribute anymore to it. That's the key.
Correct. So I believe Medicare becomes first. I believe it comes first, and ours becomes secondary.
I think there is a benefit.
Yeah. And and Medicare it's a challenge trying to sort through what's what on that as well. So having dealt with this recently, but the thing is you cannot be putting money in HSA when you're under Medicare A, because they'll make you pay all the money back. If you're getting Social Security when you hit 65, you will get A.
Right, but I'm not getting Social Security.
Okay.
I'm under A, but I'm still in having HSA.
Are you putting money yourself?
So what they tell me to do when I went down in November.
I've talked to several people, and what I've been told is they could come, if you're still putting money in HSA, they could ask you to pay back all your Social Security money that they give you in those months. That's what I read.
But what Social Security?
You say you're getting Social Security? I'm sorry. If you're getting Social Security, they could have you give that money
So
back.
it's only if I'm getting Social Security.
Correct. Yeah.
Okay.
Yes. Now, when you do leave, and you're 65 or older, you don't have to sign up for Medicare A if you're still working. But when you do leave, you need to sign up quickly, because you don't have to do it immediately because you have still coverage by Spring Arbor. But if you don't sign up and you leave, you have 8 months to sign up. If you don't sign up within an 8-month period, they'll go back and charge you a 1% penalty per month that you didn't sign up for the rest of your life. So if you're 5 years later, you pay 60% higher for Medicare the rest of your life, because you didn't sign. As long as you do it within that window, you're okay, but be very careful you sign up with Medicare very quickly when you retire, if you're over 65, because it's very bad. It's very bad. No, this is Part A. Part A. Part A. B and D is separate. But all we're saying is you don't have to get Part A at 65. You can stay under Spring Arbor. But when you do retire, if you get Social Security, if you're getting Social Security then. If you're still working, you may not get Social Security, so you don't need to sign up for A. But once you're getting Social Security, they will automatically enroll you for Part A. Does that help? Didn't mean to confuse things. Yes.
You have money in an HSA when you retire, and when you're on Medicare A, you can continue to
Yes,
use that.
yes.
You can't put more into it.
Exactly. And so actually, you've built your own retirement, if you will, tax-free, and then you can pull that out later. You can pay for any number of things, any medical thing you want to after that. Yeah, that's one of the nice things. If you want to put extra into it, you can be building up money so when you do need it.
Two things I just learned with our HSA. One, if you have a disability or long-term care
Yes.
insurance, you can run that through your HSA and have it withdrawn monthly.
Good, yes.
And, so you're doing your long-term insurance with pre-tax dollars.
Yes.
But the other thing with HSA is you better be claiming your benefit on your annual income tax. Because if you're not getting the pre-tax benefit.
Yeah.
We just learned that. You can only go back 3 years to do that.
Yeah.
So then your income tax.
Sure.
return. I thought it was automatic. I thought it was like a flex, and it's not.
No. Appreciate you mentioning that. So the key thing you mentioned there is make sure that's taken care of on your tax. But the other thing is the fact that if you have long-term health care, which is something we'll get to, you can take those out of your HSA dollars, which is after tax, which is certainly much better. And the limit you have is what, 6650, I believe. I think I've written down here. 6650. Okay, HSA. They're top of page 4. Yeah, it's 6650 this year. And if you're over age 50, you can put an extra 1,000 in. So if you, obviously you have to have the money to do that, but that would give you a pretty good amount you could put aside in HSA and build up so you could use it later if you chose to. And that's all pre-tax dollars, so it's obviously much better than after tax. With those, you have to, with the HSA account, of course, we have higher deductibles. You can see the deductibles we have. They have to have at least a deductible of $1,500 for single and $3,000 for family, which is what we have, so it's not an issue. You've already talked about Medicare Insurance. One of the things to be aware of, that some people are not aware of, is the fact that if a person decides to give money to their children or other people, and they use up all of their assets within 5 years, there's a 5-year look back. So maybe someone has, their parents give you a chunk of money, and 3 years later they find out they've used up all their assets. Now they need to go to Medicare, or Medicaid. Medicaid. Medicare is for everybody. Medicaid is when people are financially not in very good shape. They do a 5-year look back, which simply means if you've been given some money by maybe a relative, then you would have to go give it back to them if it's been within 5 years. So I've had situations last year or so, we've had relatives, they wanted to give money to certain children, and it tends to be the children that haven't handled money the best. And if they give it to them once, and they do a 5-year look back and they need to go into Medicaid, they would either have to give it all back or they'd never be able to get Medicaid. They would be destitute without the government picking up the tab. So there's a 5-year look back. It used to be 3. In fact, when Nick Smith was our representative to the national, I was with him at a conference, I said, we really need to make that more. I'm not sure that he did it because of that, but anyways, they moved it from a 3-year look back to a 5-year look back. That simply means if you know someone giving a lot of assets to another generation, which is pretty common, they look back 5 years, and if people can't afford to give that back and they're going to need it within 5 years, you're in trouble. So they always need to be careful before they give away that they're going to be able to take care of their needs, or otherwise they have to have those people give that money back. And of course, doing that's going to be pretty difficult. Long-term care insurance. I think we covered the other. Long-term care insurance, one of the things that's important to people is be aware that long-term care insurance is expensive, but the cost of long-term care is also very expensive. What it talks about is if you want to sign up for this, your best time to do it is probably in your 50s or 60s. But one thing that's happened in recent years is there's been a significant increase in claims. So the rates have gone up, I believe, 50% in the last 3 or 4 years. And a number of companies have got out of the business. And so because of that, the option of going that direction is becoming much more iffy, if you will, because the costs have gone up so much. So it's certainly something to look at. Now, with that, to be aware, my understanding, and someone maybe will correct me on it, is usually there's 2 out of 6 life skills you have to need help on before they will cover you. Whether it's eating or toileting or getting dressed and those kind of things. If you don't have at least 2 of those that are needed, you usually cannot get that insurance. I can think of the illustration again with my parents. They had it for about 20 years, and my dad could use it the last 10 days because often people are not quite to that point, and so we got all he paid for 20 years of insurance of $3,000 a year, whatever it was, and he used it for 10 days. So, and yet there's a need, and especially people get over age 85. The majority of people in our facilities are often over age 85, and by then, of course, especially if a spouse is gone, it's difficult for them to take care of themselves. So those kind of expenses are very high. So just be aware of that cost. Either you need to have enough assets to cover yourself, or I guess the other option is say you'll take a risk and cover it yourself, or get insurance. So there's a need for insurance, but at some point in time you have to say, can I afford that insurance? Or in fact, I just read an article a couple days ago about someone who was in the business, and he said even he personally is having hesitation about getting it because he said it was a no-brainer a few years ago, but now with increased rates, he said now he was becoming much more hesitant because less people are actually needing that, and when they need it, usually it was for a much shorter period of time than what they expected. So again, is it for everybody? No, but it's something we need to at least be aware of because it is very expensive. Even assisted living, I'm writing some checks, and we've of course got some number of facilities around here, but they're good facilities, but still you can run a lot of money really quick. So just some things to be aware of on that. Yeah.
It's not. We got it a year before my husband's stroke. It's painful.
So in case, yeah.
Well,
So yours must have been a much better policy than my parents got. And so it's a different policy. Yeah, it's expensive, but still in your case, it would be prohibitively expensive otherwise. Yeah. So again, is it for everybody? No. But you need to each one look at it, decide for yourself which is the best. So any questions I've not covered? I've tried to quickly cover a lot of this, probably a little more quickly than I would like to, but I want to make sure we covered these. What are some other kinds of things that would be good to be aware of? One of the key things is planning early. The earlier you plan for retirement, the better off you are. The longer you wait, it's interesting, in principles of accounting every year, I have students do they have amortization schedules to back of one chapter. So I show them, what happens if you set aside $2,000 a year starting at age 25, 35, and 45? And the numbers are amazing. They could do from 25 to 35 rather, and probably quit and still have more than if they did it, for the next 30 years. So those early years, the earlier you start, the better off because you have more time for it to grow. The rule of 72, if you want to say, what is the rule of 72? If you can make a 5% return divided into 72, it takes you 14.4 years to double. But what happens if you could get an 8% return? 8 into 72, it takes you 9 years to double. So one person's getting 5% on their investment, somebody else getting 8. You can see where the one doubles and doubles and doubles, and it's worth probably several times what the other would be at 5%. Less risk at 5%, but on the flip side, you get ready to retire, a much lower amount you'll have available to you. So again, risk, and every family is different, and our perspective changes during time. As I said before, you're younger, you can take more risk when you get older, but still we each have to look at the fact, even when you retire at 65 or somewhere in that vicinity, you could live another 20 or 30 years. And if you're just getting 1 or 2% on your investments, you're going to have trouble being able to pay your bills very well. Any other questions? You've been good at asking questions all along, so maybe that's why there's none now. Yes? Excellent question. And life insurance, basically, life insurance is to replace the income that would not be there if that person died. So the ones probably in greatest need of life insurance, one with small children. And this is the case that my wife and I are on different pages on. When it was about eight years ago when my youngest son finally was out of high school, I said we no longer need life insurance because if something happens, we have enough that she could live on it. She didn't happen to share that opinion, but we still dropped our life insurance other than what school had. Because I guess the question I have to ask, would it be better to have my wife better off with me dead than alive? And I'm not sure it's a good biblical principle that I'm better off if you're dead than alive. So, and the other thing is we get older, the rates become very high, much higher. And so at some point in time, if you build up your assets toward retirement, then you would say, okay, if this is the case, if something happened earlier, would I be able to make it? And if that happened, you say, okay, well, I don't have less people to feed, probably maybe less cars, less other expenses. Some expenses would be the same. When you get a point where you say I no longer need it, then you drop the insurance. Because once you get somewhere around 50 or 60, the rates start going up very rapidly because our bodies don't do as well at that age. Yes, Craig?
Just share with you something I found out a couple of years ago because of an email I kept receiving from TIAA CREF. Are any of you familiar with their wealth management program? You at all?
Apparently not.
Okay. I started receiving emails about 2 years ago or so from TIAA CREF about their wealth management. So I got curious about it and called. And it wasn't the idea of a TIAA CREF counselor like this come here on a regular basis back there doing less of that. But what TIAA CREF recognized, they're the #2 retirement fund in the U.S., second only to Social Security. And they started to realize that if people are retiring, they're going to draw money out of their TIAA CREF accounts and put them in other accounts. And they realized they were going to lose a lot of money over the next 20 years. So they put together this wealth management program. And so I called, and the TIAA CREF rep came out to the house. We sat down, gave you a ream of paper to fill out, asking you about your willingness for risk and so on. And we spent some time with him, and then about a month later, he came back. They run 500 scenarios based on your goals, your point of retirement, how much you think you need, and so forth. They even build in an inflationary amount for health care. And they run these 500 scenarios, and you need to hit your target 90% of the time, 450 out of the 500. And so when he came back, he said, you're doing okay. And he indicated where we were at. We were over the 90%. But he said, if you do what we would suggest, you can hit that scenario 489 times out of 500. And as I started to look at it, basically what it comes down to is rolling it over into an IRA. So it's no longer when we get our monthly statements, we don't have that lump under TIAA CREF. We get whatever's in the annuity stays there.
Sure.
But they roll over, and then they rebalance. We've done it for 2 years, and it's astounding. And I don't have to worry about it because they're doing all the rebalancing. He sits down with me once a year. He says, here's where you're at. Here's how much you made last year. And so it's a managed account. And takes a lot of load off. Or should I shift some from bonds to stock to small market to mid-market? They manage that for you.
That's why he's talking about rebalancing it. They know what it should be at each point in time. If this is at a really good year, you need to take some from there and put it in the others to keep it balanced correctly. It's kind of like it's got clothes in the dryer. What happens? They get out of balance. It goes ka-thump, ka-thump, ka-thump. They help put them on the other side so it stays balanced.
The issue is you'll find other companies who will do the same.
Yes.
But they'll charge you maybe 3 to 4% on your investments every year.
What do they charge for this?
Less than a percent.
That's great.
So the charge is
It's reasonable.
minimal
Very.
for what you get.
Sure.
So if you're interested, and again, he's in Ann Arbor. They've hired teams of individuals from all over the U.S. He was an independent financial planner for 20 years, and he's now working with TIAA CREF. So he's our personal individual to work with. Other faculty and staff on campus work with him too.
Great.
His name's John Lehman.
Okay.
And he's stationed in the TIAA CREF office in Ann Arbor.
Okay.
And,
John Lehman.
Yeah, and I really like the program.
Great.
He's been doing.
Great. Yes.
So basically what you're saying is that would be closer to an index fund rather than,
No.
as far as the fees, rather than the fees?
No. The fees are a little higher because you got someone doing more involvement with it, but you get more personalized care that way.
What you don't know is TIAA CREF's charging you even now.
Yeah.
We are paying a fee. If you're in just the standard TIAA CREF, they're not doing it for free. So
There's a cost.
he showed me the numbers, but in the end it's not out here what I would be paying a financial planner off, pointed to a place in here in Jackson versus what they're doing. It's not as low as it would be with what you're currently doing.
Sure.
So it's far lower than the commercial.
Sure.
But they do the rebalance.
Yeah.
I have to every year. I have a cousin who's a financial planner. I sit down with him every year. And I think that's one reason why we're doing pretty well, because my husband kind of guided me over a number of years, and we've done reasonably well, so we could hit these scenarios the number of times that we did. I don't even have to do that anymore.
Yeah.
They handle it all.
So you now have IRA,
You could-
Roll it all over into a TIAA CREF IRA.
So, yeah, the money keeps going into TIAA CREF, and then you can probably roll it over anytime as far as that goes.
Well, I'm not right now. I could.
Yeah.
I could do it yearly if I wanted to.
Yeah.
If I had 10 years to retire or
Yeah.
something, I could roll it at the same time
Yeah.
I wanted over.
But I mean, you don't have to wait to retirement to do is what you're saying.
No, they may have some criteria in terms of the amount. I asked him, now, why did I start to get these emails? He said, well, two things. One, the amount of funds that you've accumulated in TIAA CREF and your proximity to retirement. Triggered me beginning to get these emails about
Sure.
2 years ago.
Sure. Makes sense. Makes sense. Any other questions? If not, well, I appreciate it. We've got extra copies if people need it in the back.